Welcome to our module on financial accounting, a crucial subject for understanding any business. We'll explore how financial accounting serves as the universal language of business, essential for informed decision-making. Today, we're diving into the core of financial reporting, understanding accounting principles and why they matter. These principles are fundamental guidelines for recording and reporting financial transactions, ensuring statements are consistent, comparable, and transparent for all stakeholders. Let's now examine the key GAAP principles, which are the generally accepted accounting principles guiding financial reporting. These principles set the vital standards for ensuring transparent, reliable, and consistent financial reporting across all businesses. First up is consistency, meaning businesses should use the same accounting methods over time. By using consistent methods year to year, companies allow for meaningful trend analysis and performance evaluation. This consistency is crucial as it allows us to effectively analyze trends and compare financial data over time. Next, we have the principle of relevance, ensuring financial information is truly useful for decision-making. Relevant information must provide value and assist users in making informed economic decisions about the company. Ultimately, relevant data helps paint a complete and accurate financial picture for all interested parties. Then there's reliability, which means the information must be accurate, verifiable, and free from bias. Reliable information is accurate and verifiable, ensuring that users can trust the financial data presented. It must be free from any bias or material error, reflecting the true economic substance of transactions. Finally, comparability allows us to easily compare financial statements across different companies and periods. This principle ensures that financial statements can be effectively compared across different entities or over different periods. Comparability facilitates effective benchmarking and detailed analysis, helping stakeholders evaluate performance relative to others. Now, let's explore some fundamental accounting concepts that shape how financial records are kept. These core ideas are essential in shaping how we record and interpret financial information for any business. The entity concept states that a business is always considered separate from its owners. This means the business's financial transactions are kept distinct from the personal finances of its owners. The going concern concept assumes a business will continue to operate indefinitely into the future. This fundamental assumption allows us to record assets at their historical cost rather than liquidation value. The accrual concept recognizes revenues and expenses when they occur, not just when cash changes hands. This means we record economic events when they happen, regardless of the actual cash flow at that moment. The matching concept dictates that expenses should be recognized in the same period as the revenues they help generate. This ensures that the costs incurred to earn revenue are properly matched against that revenue in the income statement. The conservatism concept advises anticipating losses but recognizing gains only when they are certain. This means we tend to understate assets and income and overstate liabilities and expenses when uncertainty exists. Now, let's look at preparing the key financial statements, which provide vital snapshots of a company's health. These statements offer crucial snapshots, giving us insights into a company's financial performance and position. The income statement, also known as the profit and loss statement, shows performance over a period. It clearly outlines a company's revenues and expenses over a specific accounting period, like a quarter or year. Ultimately, it calculates the company's net profit or loss, indicating its overall financial performance. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It presents a detailed picture of a company's assets, liabilities, and owner's equity on a given date. Unlike the income statement, the balance sheet captures financial status at one precise moment in time. The cash flow statement details all cash inflows and outflows, showing where cash is coming from and going. This statement provides crucial details on all cash inflows and outflows, categorizing them by activity. It breaks down cash movements into operating, investing, and financing activities, providing a complete cash picture. Now, let's understand the bedrock of all financial accounting, the basic accounting equation. This fundamental equation, assets equals liabilities plus equity, forms the basis for all financial reporting and keeps records balanced. Let's now explore the different components that make up equity, a crucial part of the accounting equation. We'll delve deeper into understanding the owner's stake and how it's represented in financial records. First, let's look at the concept of basic equity, which forms the foundation of the owner's claim. This represents the owner's residual claim on the company's assets after all liabilities have been paid off. It primarily includes the capital that the owner has invested directly into the business operations. You can calculate basic equity simply as assets minus liabilities, maintaining the accounting equation's balance. Next, we have expanded equity, which gives us a more comprehensive view of the owner's financial position. This is calculated as owner's capital plus revenues minus expenses, showing the impact of business operations. We also subtract any owner's drawings, which are funds the owner withdraws for personal use. Expanded equity provides a much more detailed view of the changes in the owner's overall claim over time. Now, let's discuss the fundamental principles of double-entry bookkeeping, the bedrock of modern accounting. Double entry ensures every transaction has a dual impact, affecting at least two accounts with debits and credits, balancing the accounting equation. Let's dive into the core mechanics of accounting, debits and credits, which are essential for recording transactions. Understanding debits and credits is key to mastering the mechanics of balancing all your financial accounts. On the left side, we have debits, which play a specific role in increasing and decreasing different account types. Debits will increase your assets, like cash or equipment, and also increase your business expenses. Conversely, debits will decrease liabilities, revenues, and the overall equity of the owner in the business. Essentially, debits are used to record any incoming value to the business or any cost incurred. Now, let's look at credits, which are recorded on the right side and have an opposite effect to debits. Credits increase liabilities, such as loans, they increase revenues, and they also increase the owner's equity. On the other hand, credits will decrease your assets and will also decrease various types of expenses. Credits are used to record outgoing value, like payments, or any income generated by the business. Let's trace the journey of financial information through the accounting cycle, from start to finish. This cycle systematically moves from initial transactions all the way to preparing comprehensive financial statements. The first step is transaction analysis, where we identify and carefully analyze all financial events. Here, you identify and analyze each financial transaction to understand its impact on the business. Next, we move to journal entries, where transactions are formally recorded in chronological order. You record each transaction chronologically, meticulously using debits and credits to maintain balance. After journaling, we proceed to posting to ledger, which organizes transactions by account. This involves transferring those journal entries into their respective individual ledger accounts for categorization. The next step is preparing a trial balance, a crucial check to ensure everything is balanced. You prepare a list of all accounts and their balances to confirm that total debits precisely equal total credits. Then, we make adjusting entries to account for accruals and deferrals that haven't been recorded yet. These adjustments are vital for accruals and deferrals, ensuring revenues and expenses are recognized correctly. With adjusted balances, we can now prepare the main financial statements, providing key business insights. This includes preparing the income statement, balance sheet, and the essential cash flow statement. Finally, we perform closing entries to prepare the accounts for the next accounting period. We close all temporary accounts, like revenues and expenses, transferring their balances to retained earnings. Let's summarize our key learnings from this introduction to financial accounting. Here are the key takeaways you should remember from our discussion today. Remember, accounting principles are vital for ensuring consistency and transparency in all financial reporting. GAAP, or generally accepted accounting principles, gives us standardized guidelines for preparing reliable financial statements. Fundamental concepts like the business entity and going concern fundamentally shape how we view and account for businesses. Always remember the accounting equation. Assets equals liabilities plus equity is our core framework. Double-entry bookkeeping is crucial. It balances every transaction using debits and credits perfectly. Finally, the accounting cycle is a systematic process, guiding us from transactions to final financial reports.